why are we investing money, right? Is it to brag to our golf buddy or our friend that, we found the next whatever investment, or is it to achieve a goal, which is what we're focused on? We want to put our portfolio of clients in a manner to give the greatest likelihood, in our opinion, for them to achieve their goal. Awesome. Well, on today's episode, I'm excited, Robert, to talk about what some financial experts are putting out there, kind of like as gospel, right?
Yeah.
And I'm going to call it the lie behind how the 1% supposedly invest.
Right. Yeah. I look forward to this.
So a lot of times people talk about the 1% as if they have a whole different playbook, they have a different strategy, and a different way of investing, right? That the average Joe can't get. So I'm excited to dive into the weeds, really what that looks like, and these people that are peddling, hey, invest like the 1%. What does that look like in reality? There's fintech companies, there's wealth coaches, there's influencers that it seems like it's all the rage right now. Invest like the 1%. So let's dive into it.
Yeah. So, all right. What do you think, I guess, one of the biggest lies that you hear about how people invest in the 1%? What do you think that is?
I think the biggest lie is going to be that the reality is most ultra wealthy people, they invest pretty boring. They have blue chip stocks, ETFs, might have some mutual funds, bonds, whether it's corporates, municipal bonds. It's very boring. It's not as exotic as it's pretended to be out there. The reality is they build wealth slow, and the way they do that's through those instruments.
So, why do you think so many people are influencers or are these people online? There's always these meme pushes out there online on all these different platforms. Why do you think they're pushing it so much? What's the benefit?
Well, I think they're selling the dream, right? And that's a whole lot easier to sell something saying, "Hey, invest like the top 1%." You feel like you're in an exclusive club, right? But it almost sounds rebellious. The 1%. The reality is these instruments that might appear exotic and are exotic, they don't always have the greatest return. I mean, you really, when it comes to investing, I think you want to take a long-term approach, and typically you're going to make more money that way.
So I mean, it kind of seems like another illusion of safety, like a trap, when you think about the push that they're doing. So, how do you kind of navigate that?
I think one of the first steps you should do when it comes to investing is not focus on, hey, what is the maximum I can make in this particular investment, but what is the downside?
Mhm.
Right? Somebody might pitch you, hey, this investment's done 20%, 30%. Well, redefine print. Maybe there's 20 of those investments out there and 3 of them did make 20 plus percent and a few completely defaulted. I would focus more on what can go wrong. Murphy's Law, right?
Mhm.
What can go wrong will. I think the focus needs to be more on how bad an investment can get than the potential upside.
Well, how do they market these investments as being secure? I mean, I know, of course, influencers, we did a podcast on this, where influencers aren't necessarily licensed for the most part, but how are they still pushing these as secure investments?
Well, they're pitched as collateralized institutional investments, and it makes it seem as they're very safe. I think it's the language. Words matter.
Mhm.
So what they do is they try to use words to make these products seem something that they're not, and people don't do their full due diligence and they fall for it.
So for somebody listening today who's tempted to buy these or they they're getting pushed, it sounds attractive to them, what should they watch out for? I mean, what's the smarter or safer pick?
Yeah. Again, I would look into the details of it. Realistically, what can happen? Look at the liquidity. That's a big one, right? How often are they gonna show what's going on? Sometimes certain investments you find out once a year what's been going on. Truly, what it is invested in, is it leveraged, right? Warren Buffett's famous saying, the 3 ways to go broke: ladies, liquor, and leverage. Is that product leverage? Leverage is a fantastic way to make more money, perhaps, but it's a quick way to go broke or if your limited exposures to that one product, if it's leveraged, you could lose 100%. And this happens more often than not with companies out there that are well known. This happens all the time.
Ladies, liquor, and leverage. It can be exciting for the short term, but at the end, you're going to be broken alone. That's
Well,
what
you
you're
can speak
saying.
for yourself. I'm going to say it's never exciting.
So, well, I mean, long time ago. Um, so I know you have a story. So what's a cautionary tale that you would throw out to somebody?
Yep. So recently, and this happened last week, there was an article in CNBC that I'm going to share some of the details because, again, this isn't me, coming up with my own facts. This is CNBC, so I'm going to read a little bit of this. But just last week, CNBC talked about YieldStreet, who marketed itself on the platform as democratizing access to private investments, right? They offered real estate, art-backed loans, litigation finance, and their marketing hook is what we're talking about. Invest like the 1%, right? That sounds amazing. I'm getting access to something exclusive.
It sounds awesome. I want to do it.
I'm tempted to do it just
Yeah.
based on that hook alone.
Yeah.
But they interview a gentleman. His name's Justin Klish. Again, I don't know him. A finance professional from Miami. In 2022, he invested $400,000 across 2 deals on YieldStreet, a luxury apartment project in Nashville and a renovation in Chelsea, New York, right? Both promised 20% returns. So to me, that would be one red flag, like really 20%, okay. And this is something it's pitched as exclusive. This is a leveraged product. You're gonna get these returns that are outsized. That's nearly double what the stock market's done. So automatically, I'd be a little concerned. That seems a little high. Fast forward 3 years later, so 2025, the year we're in now, he's expecting to lose nearly everything. The Nashville deal was declared a total loss. He lost $300K in it. The Chelsea project is still alive, but they're asking existing investors to pony up more money to keep it alive to have a chance to return their principal and maybe make a small gain.
So they're already in the hole. They're already losing money, and they go back to the same investors to try and get more money in the hopes that they're like, well, I've already lost, so the only chance I have of recouping is throw more money at it. So
Yeah,
now it's a bigger gamble.
I'm sure. Yeah, 100%. But I'm sure their angle would be, hey, interest rates went up quicker than we anticipated. Maybe they had some construction delays. So, there's still a pot of gold at the end of the rainbow. We just need more money to get us
But
there.
that's not the investor's fault. I
I
mean,
agree.
the people that are coming to them for money, the builders, I mean, they're the ones that should have calculated for that. We want to
Yeah.
calculate for worst case scenario in everything we do. So by them doing that, I mean, it kind of seems like a trap.
It's complicated, right? Again, I'm not defending them. I'm trying to point out what they did. But at the end of the day, sometimes unique situations happen. But to your point, what if the investor doesn't have additional funds,
hmm
liquid, to
hmm
pony up?
You know, I was I was debating saying this, but as soon as you mention Yield Streak, I have a conversation that happened 2 days ago. And to be honest, I've never really even heard of the company, knew nothing about it. But we have a new potential client who just informed us that they're going to become a client.
Sure.
And as we were deciding which portfolio we wanted to pick for them, because we have 19 different models, we talked about the difference between equities and bonds and risk tolerance. And he goes, well, I think I have my income side, bond side, taken care of. So why don't we just go to the 100% equity model? And I go, well, let's break that down because the reason we've had the success we've had is because we have open dialogues with our clients. We know what's going on.
Sure.
So I go, well, let's break that down. What do you mean? He goes, well, I've been investing in Yield Street for the last year or two, and I'm getting some decent returns. 6% is what they're promised. And I go, my jaw kind of hit the floor because I knew this was coming. And so as we talk about it, I go, this guy's not the top 1%. He's not your billionaire next door or even your millionaire next door. He's just an everyday dad, an everyday husband that probably, my guess is, saw an opportunity, saw an ad that sounds exciting and wanted to jump in. And so since then, I've talked to him about it because this was just 2 days ago. So yesterday we were talking, and I gave a word of caution to just watch out, to protect yourself. So that brings me to this. What warning signs should everyday investors look for when they're getting hit and they're getting these things pushed on them?
There's a few warning signs, but before I get there, let me share a couple more statistics on this YieldStreet. From 2021 to 2024, they had 40 deals that CNBC investigated. Again, I'm not the investigator. I'm just repeating what CNBC had. CNBC investigated from 2021 to 2024. There's 30 deals they looked at from YieldStreet. 4 deals were total losses. 23 on their watch list, which is a fancy way of saying there's a high probability of default. And in 3 are still paying to investors. So 370 million was invested, 78 million is already gone. And something else that was a little bit weird that they talk about in this investigation. And again, I want to be fair to YieldStreet, even though I'm kind of picking on them a bit here. But their website wasn't updated correctly. These investments, they had investments that were down 100%, and the website was showing their performance was 0, right? If I give somebody $1 million and they lose me my $1 million, my performance is not 0, it's down 100%.
It's negative. Yeah.
And so again, goes back to doing research, but even sometimes when you do research on these products, it can be very murky.
Seems
Now,
like lack of transparency
yeah,
in that.
well, I'm sure they would say they were going to get to it, et cetera. Now, CNBC did point it out to them, and they did update it. So as of now, it's updated. But what if CNBC didn't say anything?
Mhm.
Was that going to be updated? Because that can change your um, opinion of investing in it,
Mhm.
right? If you're looking at it online and a bunch made money, a bunch broke even, I can deal with that.
Mhm.
But the ones that broke even, you really would have lost 100% of your principal. That may change your decision making on if you should do it.
So when we talk about these warning signs for these products that promise above
Yeah.
average returns, and I use the word promise
Yeah,
loosely,
sure.
but above average returns, what should people look for?
There's a few things. One is again, to you just nailed it. If they're promising you or saying you could get this crazy return, if it's much higher than the market, I'm a little leery, right? There's professionals that can't beat the just the U.S. stock market, and I'll be specific, the S&P 500.
Mhm.
There's that saying, "Be greedy when others are fearful, fearful when others are greedy," and I think people take this out of context. They're thinking, "Oh, I'm going to be greedy because this investment's 20%. Yeah, there's some downside." And they take on what I would call unwise risk,
Right.
right? I'm all for taking risk, but you want to be in. If you're in the S&P 500, rarely does a company completely go under. Yeah, we have Enron, we have companies that do from time to time, but they're liquid, right? You can get out. You know what's going on. These products can be tough. So I would say uh, when it comes to that quote, "Be greedy when those are fearful," I would imply that or use that in a context of if the stock market comes down or real estate comes down, and you're a real estate investor or stock market investor, all things equal, you should be more attracted to jump in with both feet into the stock market, right? But if you are using that concept of, "Hey, I want to be greedy when those are fearful. I'm trying to find this needle in a haystack," man, I would redefine print, be very careful, liquidity is a big one.
So
If
so let me ask, are you saying people should never invest in alternatives or just be cautious in the alternatives they invest in?
I would be cautious. Now,
Mhm.
there's some alternatives that can make sense. Here we do options from time to
Mhm.
time that the way we structure it, you could consider that an alternative.
Mhm.
But I would be careful. These firms that they're not even good at investing money, they're just a marketing machine, right? They're wealth management companies that are a marketing machine, and they come up with these super amazing catchlines. To be honest, we're democratizing investing. We're bringing down this to the common people. Man, oftentimes what's happening is they're getting these products that the first wave of investors, they're already done. They made their multiple 1, 2, 3, 4, 5, 6, 10x. They're out. So they're looking for the next sucker to pass it to. And you don't want to be left holding the bag, assuming, well, the first investors made, this crazy return. I want some of that. Yeah, that was had you got in 3 years ago. They're looking to offload on you.
So, I mean, it seems like, and correct me if I'm wrong, but it seems like that when you talk about the first investors, the initial ones, Well, those are the multimillionaires, the billionaires. They're the first ones that normally get in. Then they promote the hype. They get out there and they put the money out there that they've already made a ton, so they can take a little bit of that profit, push the product, then get the everyday investor in, act like they're helping them out, bringing them along, jack up the stock price, sell out, and who's holding the bag?
In some
In
cases,
some cases.
I mean, I don't want to do a blanket answer on all these, but that does happen. To put it in context, I don't think, by the way, I don't want YieldStreet to be mad at me. I don't think that's what happened here. I just
Right.
think, they did some real estate. Real estate can be risky, and
Mhm.
they lost a chunk.
So let's zoom out for a second.
Okay.
Most people that are chasing alternatives or that want to chase alternatives or even thinking about it, they have this mindset that they may beat traditional investment strategies.
They may beat it,
They may
make
beat
more.
it.
Yeah.
So, but the numbers don't really say that. Is that what we're saying?
Well, it one size doesn't fit all.
Mhm.
There's some that do, but I think what's super important when it comes to investing, like we talked at the top of the hour, is not so much what you might make, that matters, but it's what you could lose.
Mhm.
So let's use the following analogy. Let's say you had two investment choices, investment A and investment B. Investment A, you can put $100,000 in.
Okay.
Okay. You put 100 grand in investment A, you invest it for 20 years, and you make 7% per year for 20 consecutive years.
Okay.
You can put 100K in that, or you put 100K in a portfolio B, which makes you 21% the first year, loses you 7 the next year. Up 21, down 7. Up 21, down 7. Up 21, down 7. Up 21,
For
down
20
7.
years.
For 20 consecutive
Okay.
years. Okay. Now, when we do seminars, when I ask people this, I go, which one do you think after 20 years will grow your 100 grand the most, regardless of risk? Don't worry about risk right now.
I love how split the room is in the seminars when we ask that
Yep.
because everybody wants to guess.
Yeah, I would say it's almost 50-50
Yeah.
when people, and although I do encourage them, I go, just throw out a number. Don't
Yeah.
overthink it. It's about 50-50. 50% say, well, if it's 777, that'll make you the most money. 50% will say if it's 21 up, 7 down, because man, if you had $1 million, it goes up, 210,000 and comes down, you're gonna end up with more money. And the thing is, by the way, they both average the same, right?
Right.
If you take a minute, think about it, most people can probably figure that out pretty quick. 777% per year for 20 consecutive years averages 7. 21 up minus 7 is 14. 14 divided by 2 is 7. So they both average the same 7. But I'll repeat my initial question. Which one after 20 years will give you the biggest pile of money? Now, the first one at 777, while it averages 7, it also compounds at 7, which, by the way, that's where it's at. When I look at returns, I might glance at the average, but that doesn't really matter. I'm looking at the compounded rate of return because somebody may, if you give somebody $1 million and they lose you 50% and then they make you 50%, where are
You're
you at?
750,000.
Exactly. Because you went from $1 million
Mhm.
to $500,000, then you make 50%. Now you're at 750.
So your average is 0, but your
That's what
compounding.
some people would try to
Yeah.
argue.
Yeah.
Yeah, but you're down 25%.
Yeah.
So again, a 777 averages 7. You're compounded at 7. The one that's 21 up, 7 down. 21 up, 7 down. It averages 7, but it compounds at only 6.08. So for every for every $1 million you have, you're gonna make like a 10K less on the one that's 21 up, 7 down, 20 up, 7 down. And that one on a surface, it kind of looks more exciting,
Mhm.
right? To throw a quick number at you, the 100K and the one that did 777, after 20 years, you would have about $386,969. The one that's 21 up, 7 down, 21 up, 7 down, after 20 years, you would have $325,599. So 60K less. If you had $1 million, that's 600K less.
Add another 0.
Exactly.
Yeah. So thank you, because that's such a solid way, I think, to break everything down. So as we wrap it up, what are kind of the final thoughts that you think about when talking about alternatives and just what people need to watch out for and avoid?
I think you want to really know, just because somebody says that something's exclusive, know the liquidity, know how it works, get into nitty gritty. If it's leveraged, know what you're buying. And I would say boring wins the race. I think I already said this, but if I'm in a race, I want to be the tortoise. I don't want to be the hare. When we build a portfolio, a lot of our clients, the way we invest their money, they have ETFs and we have individual stocks, right? That's the brunt of the portfolio. And sometimes I remember sitting down with clients and it'll be like, oh, they look at it right before they look at the performance, but they'll look at something and be like, I can see it in their eyes, kind of boring. I mean, I'm not investing my money for excitement. If I want excitement, there's plenty of avenues I can take. I'm investing because I work very, very hard and I want my money to work very, very hard. So while Walmart, you could argue, is boring, it's up 70% last year. What's more exciting to you, being up 70%? In that stock now doesn't mean the whole portfolio was up 70. So
But you
obviously,
get those little wins, though.
exactly,
If you're diversified and a number of them see growth, you get those little wins.
exactly.
Yeah.
And it's with a lot less risk. Could Walmart go bankrupt? I suppose, but it's unlikely,
Yeah.
right? One of the biggest companies on the planet. It's a cash cow. But by having these blue chip stocks, boring stocks, I would encourage people, don't feel like you have to make a ton of money this year, next year. Just compound your money. Consistently try to make money. Make your portfolio. Yeah, you might have some dips once in a while, but you try to minimize those. I would argue that is going to give you the biggest pile of money, the biggest return over time than exposing yourself to a liability of losing 100% on a portion of your account. Don't fall for those get rich schemes. They don't exist. I would say people that I know that are wealthy, they got wealthy typically one of three ways. They own a part of a business, right? Maybe they started it or they bought their way in, etc. They invested in stocks or things like stocks for a very long time, and they accumulated those assets, right? Over decades, they grew their a nice net worth. And the third way is, which people probably prefer, they inherited it, right?
Yeah.
So those are three ways: starting a business or owning part of a business, just the old-fashioned way in equities or like equities, or inheriting it. But I've met very few people in over 20 years of doing this that put a chunk of money in some alternative investment and consistently knock the cover off the ball. That hasn't been my experience.
Well, I know you're a baseball family, and I'm becoming a baseball family now that my kids are getting into it. But I didn't grow up knowing much about baseball. But one thing I have learned over the years is that consistency, singles and doubles. If you step up to the
Yeah,
plate and you're trying to
that's
swing
right.
for home runs every single time you step up, you strike out a lot.
Yeah.
But to win the game, it's all about singles and doubles.
And that's the thing to remember. Why are we investing money?
Mhm.
Right? Is it to brag to our golf buddy or our friend that, we found the next whatever investment, or is it to achieve a goal, which is what we're focused on? We want to put our portfolio of clients in a manner to give the greatest likelihood, in our opinion, for them to achieve their goal. And even if you're out there and you're, say, a do-it-yourself or you do your own investments, I would encourage you to have that same mentality. Don't be looking for those grand slams. And if you do make it a small fraction of your account. Maybe it's I don't know, 1%, 2%. But there's situations where we've seen people put a large portion of their account looking for that grand slam, and more often than not, not only is it not a grand slam, it's not even a single or double, it's a strikeout, and now they set back their retirement 4 or 5 years.
All right, Glenn. So it's time for the mailbag question. And this one is pretty simple. I think you're going to knock this one out of the park. No pun intended for our previous conversation.
Okay.
But this one's from Joe. I'm not sure where Joe is located, but this one's from Joe. And he's asked, what does it mean to work with a fiduciary?
Well, I'll answer that by explaining what a fiduciary is and the other alternative, right? A fiduciary is obligated to do what's in your best interest. And oftentimes when we say that, people just assume, isn't that everybody? No, unfortunately, we spent 10, 11 years at a big wirehouse, if you will, that was gobbled up by Bank of America. That is Merrill Lynch. But those type of firms, um, most advisors are brokers, and they work under the suitability standard. And what that means is when they pitch you an investment, it just needs to be suitable.
Suitable for what? Your needs, your risk, your
Exactly. For
age?
both, but it doesn't need to be, even in their mind, what the best thing is out there.
Mhm.
Does that make sense?
So
So
there could be hundreds of investments that might be suitable
yeah,
for somebody, but there's one that's the best.
exactly. If you're a fiduciary, you have to do what you think is the best.
Mhm.
And when it comes to investments, sometimes there's the identical investment, the same wrapper, same everything. The difference is a client and one pays 200% of what the other one is.
Mhm.
If you're a fiduciary, as are we, a fiduciary fee only, you have to do what's in best for the client, right? If you're working under the suitability standard, you just have to say, oh, it's suitable for them. And for the record, you have no obligation to stay on top of that from after the moment that the client invests in that product.
Yeah. So as a fiduciary, no handcuffs. You have to have open architecture to go pick the best investment for the client, not just
Exactly.
what's suitable for the client. Because dozens of investments in any sector could be suitable for a client. It doesn't mean it's in their best interest
That's right.
or it's the best one out there. Well, thank you, Glenn. I appreciate you answering that question. And for everybody watching, if you have any more questions, feel free to tag them on any one of our social media platforms or to email them to us at gds@gdswealth.com. Thank you again. Look forward to the next episode.